Hi, folks. Adam Taggart, co-founder of Peak Prosperity here, back for another week talking with the lead partners at New Harbour Financial, the financial advisory firm endorsed by Peak Prosperity, trying to make sense of what's going on in today's markets. As always, we're joined by the two lead partners from New Harbour Financial. That's Mike Preston. Hi, Mike. Good to see you again this week.
Hey, Adam. Nice to see you.
And John Lodra. Hey, John.
Hey there, Adam. How you doing today?
I'm doing well, although I'm looking at myself in the video here and I'm really seeing the whole coronavirus going without a haircut for several months effect going on here. I'm beginning to feel a little bit like a caveman.
Well, I appreciate you looking at hair there because some of us don't have so much.
I don't have all that much, but thanks. All right, guys. So I just want to jump right in on what's been new since last week. So last week, we talked about that we were beginning to see a little bit more volatility creep in than we'd seen before. And the week had been trending down and then got sort of stick saved at the very end of the week. And then, of course, on Sunday, Federal Reserve Chairman Jerome Powell came on 60 Minutes and gave his version of happy talk, and the markets immediately jumped to a new high plateau this week and have been hanging out there. But I want to really just hand the baton straight away to you guys, just to give your commentary on what you've seen over the past week, what's catching your attention, and any your initial reactions to the continued jawboning on behalf of the Fed. So, John, why don't we start with you?
Yeah, so I actually watch 60 Minutes pretty religiously. I think it's an interesting program, not always necessarily fully disclosing of the truth, and this actual interview with Jerome Powell was a case in point. They always do a very nice job polishing them up, and Jerome Powell talked about the coronavirus obviously has been a big impact, but he said hey, two or 3 months ago before coronavirus, the economy was in great shape, which is just jaw-dropping because, most folks don't realize that last fall, the Fed was injecting tens of billions of dollars every day into the overnight repo markets, which are the lifeblood of the financial system, the overnight lending. And this is not the kind of behavior of a very strong economy. It's a behavior of a very sick financial system. And to get on national TV and not even mention that, not expected, of course, but that just gives you a very succinct data point of the degree of obfuscation that certainly the Fed and many folks, even though the happy talk is very generous and plentiful, there's definitely some real troubling problems underneath the surface.
I'm so glad you mentioned that, John, because I actually kind of jumped out of my chair. I had a jump out of your chair moment when Powell said that. And I had to explain to my wife afterwards exactly why I'd been so riled up by it. But yeah, he had said the American economy is strong. It was strong before coronavirus. And just like you, I was thinking, no, it wasn't. We had the whole, repo market bailout going on at that point in time to the tune of 100 to close to 200 billion, in the overnight lending market because something was dangerously broken in the system. So to your point, not only, did he obfuscate a little bit, but I think that was actually disingenuous. The other thing that I really fault Scott Pelley, the journalist, for not asking Powell, because I think anybody with you don't need to have a deep understanding of the markets to ask this question. As Powell said, I wouldn't bet against the American economy. The American economy is strong and it's going to get stronger, but we're positioned here to continue to pump however many trillions might be needed to get through this time. And I'm just thinking, how can you say it's strong and yet say you're standing by with an unlimited, infinite printing press to print additional trillions? Those two things they're mutually exclusive, right?
Yeah, Adam, on the topic of 60 Minutes, I think it'd be very, enlightening for folks that maybe don't follow this stuff as closely as we do to go back and look at the archives and look at the 16 Minutes interview that was done with Ben Bernanke back in, I think it was 2009, essentially in the early days of the Fed's response with TARP and the quantitative easing. And if you watch that interview, everything about it was, yeah, we've got some major emergency measures we're putting in place, but they're not going to be here for very long. We're not going to need them very long, and we're going to do everything we can to return to kind of a normal policy stance. And guess what? That never happened. Even under this, miraculous, best recovery of all time, those measures were never removed. So I think the disingenuousness of this whole, speak can be seen very clearly if you go back and watch that 60 Minutes interview with Bernanke back in 2009.
I'm glad you said that. And just to rile ourselves up even more, Scott Pelley asked Powell about America's debt situation, and Powell had talked about pre-coronavirus had been advising Washington to try to sort of get its debt spending a little bit more under control, have a little bit more fiscal discipline. And Powell went out of his way to say, I think that way in general, but right now we shouldn't be worried about that. We should be lending as much as we need to get through this period of time. And Pelley asked, well, okay, so what happens with all that debt? And Powell said, oh, well, when things get better and we're through this, then we'll start growing the economy and we'll start paying that debt back down. And I was just thinking, there's absolutely no way that's going to happen. I mean, Powell just went through 2018, right, where the Fed since 2009 had increased its balance sheet from $800 billion to $4+ trillion and just begun to try to do a little bit of quantitative tightening. I think they got the balance sheet down to like $3.7 trillion. And the market threw such a hissy fit that Powell did a complete 180 and spent the second half of 2019 basically pandering to the market and saying, oh, you need me to give you more, you need me to give you more. And it just proved that there's no way the central bank can get away with tightening without killing the market. That's part of the whole Franken-market, syndrome that we've been accusing the Fed of causing. So again, for Powell to say that, to act like, oh, it'll be the simplest thing in the world, we'll just magically get back to growth, and of course we're going to be much more fiscally responsible then and pay down our debt. I just thought that was the height of disingenuity. Mike, do you have anything you want to contribute to this little rage fest here?
Not really. I think you guys covered it. There is no plan. It's clear. Early on, they thought that growth was going to return. I think central bankers thought that they could, print money to get us through a rough spot, and then growth would take over and take care of everything else. It's clear that's not going to happen. There is no plan. I'm not sure there ever will be a plan other than more of the same. So our message is just to, batten down the hatches, be prudent, reduce risk, because, we all assume that they know exactly what they're doing, and they're very intelligent people, don't get me wrong, but they don't really know what they're doing. They don't know what the ramifications are, in my viewpoint. And, we think that there's going to be a cost to it all. And frankly, that there's going to be some significant losses ahead in markets and in the economy. So batten down the hatches, don't listen to all the happy talk, and be careful.
Hey, Mike, I just want to add to folks that haven't already watched it. We recorded a great discussion on the central banks and the impact that they're having on our future in Peak Prosperity's recent What the Fed, WTF, What the Fed, Round 2, which is a follow-up discussion to a similar webinar that we had done at the beginning of January. So actually before the whole coronavirus hit the scene. This is with an amazing panel. It's with Grant Williams from Things That Make You Go and Real Vision, Mike Maloney from Gold Silver, my co-founder at Peak Prosperity, Chris Martinson, Charles Hugh Smith from Of Two Minds. If you're interested at all in diving more deeply into some of the evils of central banking and the damage it's doing to our future prospects as individuals and as a society, you will find a great hour and 20-minute discussion in that in that video, and we'll put the URL to it up here on the screen so that if you're interested, you can go watch it yourself. All right, guys, let's move on now. Every week we do a couple quick numbers. I want to dial through just a few this week. I won't be as chart heavy as I've been in past week, but let's start, as we always do, with the initial jobless claims numbers. We're now into week 9 since we started seeing the impact from the coronavirus. And good news, there were only 2.4 million people who lost their jobs last week. That is historically, again, that number would be a record in and of itself for a weekly tally if we weren't, if we didn't have the previous couple weeks to compare it to. But now at week 9, I think we are now looking at over 38.5 million people who have filed for unemployment. So again, everything I've been saying every week, this is historically unprecedented. It is, these are recession, Great Depression type numbers. While, a number of those folks are hopefully going to be able to get hired back as the economy begins to reopen here, a lot of those jobs are just not going to come back, and we are not going to hire those people back on any other timeline that's not measured in years. So this is something that's going to take us a long, long time to recover from. I'm going to put up a chart here from Sven Henrik. I'd put up one of his technical analysis charts last week. This one's just more sort of gallows humor. It's a chart of the unemployment rate. The x-axis is cut off here, but the numbers here go back to the 70s. You can see some spikes in unemployment as we go through some recessions and the Great Recession there in 2008, 2009. And if right at the very, very right end of the chart here, you see that it just spikes way up near 17.5%. And Sven, who has a very acerbic wit, says, "I'm so old, I remember when this would have been considered bad news." It's just horrible data, folks, and yet we have stocks back very close to their all-time highs, even though almost 40 million people, in fact, I'm sure many more than 40 million people in the US alone have lost their jobs. We only know about those 38.5 because they filed claims, but there's millions more that can't file claims or haven't yet for a variety of reasons. And we know from GDP numbers and industrial production and whatnot that it's looking like, we're looking at economic activity loss somewhere in the 40% range for Q2. Real quick, I'm just putting up existing home sales, which have fallen at the, they've not fallen this much for 9 years. So the last time the existing home sales volume dropped this much was right in the middle of the Great Recession. So, basically the 10-year bull market that we've had in housing definitely seems to be in jeopardy here. We've talked a little bit in the past about how we think that what's going on right now is going to have tremendous repercussions for housing. The housing market is a lot stickier. Prices are a lot stickier, meaning they're a lot slower to move than the stock market is. But I think if you are holding on to real estate, whether it's your house or whether it's real estate that you're holding for income investing, you better be prepared for market values to take a pretty big hit over the next year or two, at least. Last, I'm putting up a chart that, John, I think you had sent over. This is a Shiller PE ratio tracking the U.S. misery index. And the thing to note here is that the gap between the two has never been as high as it is right now. The Shiller PE ratio is the sort of green-blue chart line in the chart here. The misery index is gray, and if you look all the way over on the right of the chart here, you'll see that the blue index dipped a bit and has bounced back up, but the misery index has just plummeted down. And those two numbers, historically, you see they trade, somewhat in lockstep with one another. To keep that relationship, they're going to have to catch up to one another, and they're going to have to catch up real quick, either by things getting a lot less miserable or stocks coming down. And for all the reasons we talked about last week, I think it's a heck of a lot more likely that stocks are going to drop down to catch up to the misery index than vice versa. So, gents, that's really just sort of reiterating and reinforcing the discussions we've been having over the past couple of weeks that stocks remain extremely divorced from the fundamentals of the market. I think one of our last write-ups to one of our last videos, I coined the term maximum stupid. It's just at this point crazy making to try to even pretend to justify why stocks are worth as much, and in some cases more, post-coronavirus than they were pre-coronavirus, when there's been so much destruction. What else do you guys have to add here? John, let's start with you. Anything new this week in terms of the market activity, valuations versus market prices, et cetera?
No, it's pretty much just, as much as the daily news wants to, have folks read that, stocks did this or that, we've basically been tracing out a pretty sidebound range here for the last few weeks. We had a pretty sharp move there off the bottom in March, but we've had a bunch of to and froing for the last couple of weeks, and we're right kind of in a place today where we close today. It's Thursday, the 21st of May. Where we were a couple of weeks ago, and this is definitely a market that's kind of trying to wrestle with this disjointedness with what's going on in reality and where markets are. I think it very likely will prove to be a point in the sand or a line in the sand that the markets repel against and resume a leg downward, especially as we start to see more and more validation of the real damage that's being done on the economic basis. Things like precious metals have continued to be very strong. Gold mining stocks. There is no free lunch in the printing money and the stimulus to try and rescue things from a financial standpoint. None of that printing does anything to solve the health challenges that are at the heart of what's going on with this virus, and they certainly aren't. Printing doesn't bring customers back to businesses that are affected by this. So markets definitely have, I think, started to wrestle with the kind of the contradiction of reality and where markets are priced.
Okay. A question for you about gold, since you mentioned it, and we've talked about it. We sort of check in on it relatively regularly in these weekly updates, and it's certainly something that Peak Prosperity has been recommending for years and years. It's nice to see that the precious metals are finally beginning to show some strength. It's not surprising in the sense that you would expect them to do that with central banks printing as much as they are. If you guys, continue to expect, a market downturn here, we sort of talked about the high likelihood that what we've seen over the past several weeks has been a bear market rally, and that when you have a big market correction or crash, it's usually, an initial drop followed by a bear market rally. It fakes people out. We've talked about the psychology of that, right? It's supposed to convince them that we're returning to normal, and then it pulls out the rug from under them and it drops precipitously, right? The biggest drop is usually the one that follows the bear market rally. If assume for a moment that happens here, your prediction comes to pass. Do you expect that the mining stocks and or the metals will fall along with the market as well? And if so, do you have any defensive measures in place to protect against that? Are you planning on maybe taking profits at some point and then getting back in after things drop? How are you guys looking portfolio management wise at the precious metals and the miners right now, given that risk of another downdraft?
Yeah, I'll answer that, Adam. Precious metal miners have been pretty divorced from the market in terms of their correlation. Really, they tend to act opposite. On up days in the market, mining shares have been down for the most part, and on down days in the market, they've been up. Other than in March, when there was that first kickoff of this bear market, early March, there was this quick deflationary scare, which we think a lot of people were acting in a knee-jerk fashion, thinking, what happened last time we had a big bear market? What happened last time the market fell precipitously? Well, precious metals sold off quickly. That was back in 2008. So we saw, silver went from like 17 to 11, and gold fell $100 to $200. And mining stocks like the exchange-traded fund GDX went from 30 to 16 or so, literally in a matter of a week. But that was quickly reversed, and the whole complex, kind of took a slingshot ride higher. We think the metals and particularly the miners will continue to probably trade inversely to the market. So if we get a big sell-off, if we get the third leg or the third wave down, as you just described, which, by the way, is the most damaging and the quickest leg of them all, generally, up to 80% of bear market losses can happen in that third leg down. So that's the one that we're cautious of. Timing on it is impossible, but we think it's happening soon. We don't expect the mining shares to follow the market lower. Obviously, we don't ever rely on hunches or guesses. It could happen, and we have hedges in place just in case that does. We're very well skilled with options. We use lots of options, and we have options positions around our gold mining shares to take the downside off the table beyond a certain deductible point. So at present, it's about 18% or so below current prices where our put options would kick in, and we're probably going to keep that hedge on. The one that we have on right now goes out to the third week in June. And we'll probably very likely, depending upon prices, adjust that hedge upwards. We essentially have a collar on the position. So as mining shares move up, we keep moving the collar up so that it allows us to stay in the position more comfortably. And the downside of put options is that they cost money. We're defraying some of that cost by selling partial positions, call options at prices higher than the current level of our gold miners. So again, we expect the stock market to go down shortly and probably in a big way. And we wouldn't necessarily think the miners are going to follow them yet. If we're wrong on that, we've got some pretty good hedges on.
All right, thanks, Mike. That's a great answer. And for new folks watching who haven't watched previous videos, we've talked a lot about how one of the reasons why Peak Prosperity endorses New Harbour is because of their use of risk mitigation tools and their big focus on risk management. And Mike mentions, options and some of the tools they create from them, like collars and whatnot. And that's really all to limit losses. So these guys, if you've heard of options as a speculative tool, yes, people can use them to speculate and oftentimes can take great risks and maybe lose a lot of money at the same time. When New Harbour uses options, they're using it more in the same way that you buy insurance and to lower your risk. And if you want to learn more about that, you can watch some of the previous videos with these guys where we've talked about it at more depth. Hey, one more question for you guys on the markets, and then I want to get to what people are talking to you about these days. What are they calling you with? What questions, concerns, needs, etc. But I want to talk for a second about China. So, for much of 2019, right, it was rumors of the great deal, trade deal that was going to get done with China that really drove the market higher, really all through 2019, right? I mean, Trump just needed to tweet about it, or Mnuchin needed to say something, or the Chinese themselves needed to put out a quote, and the market would instantly jump, Pavlovian style, right? So here we are post-coronavirus. Right, where now we're at loggerheads with them. Right, there's a lot of finger pointing back and forth. U.S. accusing China of unleashing this virus on the world, not telling the world about it. That type of stuff. Chinese, understandably and obviously, reacting negatively to that. There's tensions around Taiwan and Hong Kong. It's now really been escalating, and this is an election year for Trump, and I think he's probably doing the political calculus and saying, hey, I can probably score some points by demonizing China and looking tough. Recently this week, there's been a spat where China's been threatening, the U.S. has been threatening to delist Chinese companies like Baidu and Alibaba from the U.S. exchanges, and China is saying, you're not going to fire us, we quit. They're threatening to pull their companies off the exchanges before they get delisted. And there's a lot going on even just today with Hong Kong, where China is basically tightening its control. It's finally sort of reducing the autonomy is too strong of a word, but the looser form of government that Hong Kong has enjoyed since China took it over from the British. And right now, there's a lot of tension between U.S. lawmakers and China, warning China to respect human rights and whatnot. And it's getting to the point where it's looking like the U.S. might actually be, I don't know what sort of legal action they can take, but there's talk of sanctioning Chinese officials that are involved in any sort of crackdowns in Hong Kong and whatnot. But where I'm going with all this is there is no freaking way that a trade deal is going to get done between the U.S. and China, certainly not of any kind of scope as what was being sold to us last year. And yet I don't see any visible discount being taken off the market for that, right? There was a huge premium that was added to the market throughout 2019 for this trade deal. Now nobody believes it's going to happen, and yet the markets are acting, they're giving it full credit still, right? Curious, do you guys see a similar disconnect there, and any other thoughts to add to that, John?
Yeah, absolutely. I mean, it's and that's what happens in psychologically driven expansions, bubble expansions. There's a whole lot of credit given to positive news and not a commensurate amount of clawback given to revisions on that positive news. And it's usually those clawbacks come usually in one fell swoop. Not literally, but that's why bear markets are called what they are. They're clawed back over a very short period of time, where bubble and late stage speculative advances of bull markets, it's seems like every day there's little bits of it of fairy dust that levitates things, and the removal of that fairy dust doesn't immediately reverse, but it's in big fell swoops. That's why we get the 30, 40, 50% or more downturns in markets that seemingly come with no relenting pauses. And that's just the way that psychologically driven markets work. And so we expect, when these markets price back in reality and a psychological shift occurs, a lot of those, departures, contradictions get corrected really quickly in big swoops, not little incremental give backs.
That's a great point to reinforce around psychology, and certainly in psychology of investors. How quickly it can switch, but also how so much of it is psychology driven. And that brings me to the last kind of main theme I want to talk about with you guys today. We were doing a little bit of discussion turning the video on here. I was asking you, what are people calling you in with? What questions, what concerns, what needs? And it was really interesting because you guys your experiences sort of were on opposite ends of the spectrum this past week. Mike, it sounds like you have talked to a number of people who are sitting on a lot of cash and trying to really figure out, given all the dust that's swirling in the air, what to do with it right now. What are you advising folks right now?
Yeah, a lot of the people I've talked to, it's certainly been a theme for me that the people that I've talked to have been very heavy in cash and have been for a long time. A lot of people have been in cash for years. And just recently, over the last few weeks, have said that they feel increasingly worried. Certainly interest rates have gone down from maybe 1.5% on short-term T-bills to close to 0. That happened over the last couple months. But I think it must be with the way the Federal Reserve stepped in, along with other central banks in March, and even the 60 Minutes interview with Jay Powell that John mentioned. When they said there's no limit to what we can do. We just create money digitally and put it in the market, almost as if that was a thing to brag about. I think that really hit people. And I talked to a bunch of those people this week, and they said, what to do. And I said, when we talk to people that aren't already clients, what we recommend they do is immediately assess their risk and reduce their exposure to the stock market. 30% or less equities is what we're recommending. Then take a look at their debt situation, pay down debt, and get some precious metals if they don't already have some bullion. But then what's left is a lot of times a big pile of cash. And people don't, and assuming that they're not a managed client of ours, or even if they are and have a bunch of money on the outside, they're saying, what do I do? And there's not a lot of good answers. Both of you and John talked about the psychologically driven market. This is really a psychological effect that the central bank is trying to get to cause people to be uncomfortable in cash. And, the idea is to get you to buy houses and stock market and things like that. We think our advice is that we're probably going to see a good bit of deflation before we see inflation and maybe hyperinflation. So our advice is to sit on cash, really short-term, high-quality treasuries or FDIC-insured deposit accounts, things like that, so that you can take advantage of lower prices ahead, both in the stock market and in the real estate market. We think that there's going to be lower prices. A lot of people are concerned about, well, what if we go right into hyperinflation? That's possible. That's why, not likely in our view, we think that's deflation first, but it is possible that we're wrong and we go right into hyperinflation. That's why you want to have some exposure to real things, tangible things, particularly gold and silver. I know, Adam, recently you wrote a piece about reducing cash a little bit more and buying more silver. We totally agree with that. Add to precious metal positions if you're not already too concentrated. Silver is still a relatively great value compared to gold. I think when we talked a week ago, silver was 113 to 1 in terms of the price of silver to the price of gold for 1 ounce of 113 ounces of silver for 1 ounce of gold. That has since been reduced to 100 to 1 as silver has recently rallied, but it's still a good value. So overall, still our advice is to sit in really short-term cash, increase precious metals holdings if you feel like you're not appropriately allocated already. stay out of the market and get ready for better prices ahead. It's not a comfortable place to be, but we want to help people not to feel pressured into doing something. You know, don't buy junk bonds, don't buy, you know, municipal bonds just because you feel like you have to do something. A lot of the bond indexes that we follow lost 10 or 12% in March. They've since bounced back and recovered most of those losses, but there's no free lunch. Heavy cash is still what we're recommending. So that's what I've been talking about. John, I think, has probably had some different conversations.
All right. And John, we'll get to you in just a sec. Just to build on a couple quick things you said there, Mike. So yeah, you talked about how with interest rates basically going to zero, what the Fed is trying to do here, and also this is the role you said of a bull market, right? It's to push everybody out on the risk curve, mm-hmm. right? It's to make cash so painful to hold that you get out there in the risky assets that they want your capital in, and of course, you know, that puts you at greater risk. There's a reason it's called the risk curve, right? It puts you at greater risk for when that downdraft does happen, you're out there in the risky stuff as opposed to in safe cash. So part of this, and this is one of the reasons why we really value New Harbour as a financial advisor, is to stay true and you know, remain committed to your thesis, right? Which is, hey, if we think that lower prices are ahead, we're not going to get seduced by the siren song, or we're not going to get bullied into assets that we don't feel comfortable holding for you know, fundamental reasons. So thank you for reinforcing that. Secondly, you mentioned the alert that I wrote. I'll put a URL up here for folks that want to learn more about that. And you categorized it exactly right, although I do want to underscore that it's taking a relatively minority percentage of my dry capital in cash and moving more of that into precious metals, specifically silver. It's not saying get out of your cash and move it all yet. There are circumstances under which I would say that, but we're not near them yet. And then third, I just wanted to say that one thing that people can do if they're sitting on a bunch of cash is if they are hoping to work with a financial advisor like you guys, it does take time to move your cash over to a financial advisor. You know, there's forms you got to fill out. There's due diligence that needs to happen. There's all sorts of questions about your, you know, risk tolerance and all that kind of stuff. But it just, the mechanics of going through the whole funds transfer and account setup and stuff like that takes a lot of time. And if you want to be positioned for, you know, if you're looking to deploy that dry capital at better valuations, we don't know how long those valuations, those good values, are going to be around once they're there. And so you want to have your money in a place where it can be rapidly deployed when the environment's right. So if you're sitting on cash and saying, yeah, when the time's right, I'll maybe work with these guys or someone like them, you may find it takes so long to do the mechanics of getting all the fund transfer stuff done that you've missed a good deal of the window of opportunity. It kind of reminds me sometimes when people come to our seminars, you know, we talk about the 8 forms of capital, about what makes true wealth. And the one that people always score themselves the lowest on is social capital, which is sort of community and your relationships. And every so often there'll be somebody who says like, well, yeah, when times get really bad, I'll go get me some of that. Like they're going to go pull it off a shelf. And it's like, no, you build that over years of trusted relationships with people. You just can't go out and get it. And there's a little bit of a parable to be drawn here where you can't just go from 0 to 60 here. You've got to, you know, have put all your stuff in the right place to be able to move it. So if you're one of those people who's just sitting on a bunch of cash and haven't really figured out your deployment plan yet and who is going to deploy it, you or a financial advisor or whomever, do yourself a favor and get all your ducks in a row and get all the pre-work out of the way so that you can move when the time is right. All right, now, John, moving over to you, Mike has been talking to people who have been, you know, perhaps, you know, flush with cash and wanting to do something but not sure what to do. Sounds like you've been talking to people who are more fully invested in the market and maybe thinking, hey, maybe I've had a pretty good ride over the past month, but I'm beginning to get nervous. Is that true?
Yeah, generally true. I have had some conversations with folks that are largely in cash, and you know, not only, you know, everything that you and Mike just said, but it's also a great opportunity to talk to these folks about things like paying off debt, right? So there's other things you can do besides put your money into markets, right? There's sensible things you can do to consumer debt, you know, vehicle loans, things like that. You know, obviously you want to take a big picture view, but nothing says you have to put your money into overvalued assets. A great opportunity to think about. And we do a lot of this. We spend a lot of time talking with our clients and prospective clients about things to do with their money other than to have us manage it, because there's plenty you should be doing other than paying us a fee, I guess, just to put it bluntly.
Well, that's a great point, and I'm sorry to interrupt, John, but folks forget paying off debt, that's a guaranteed return, right? I mean, you put your money in the stock market or other types of investments, you've got a hope of what it might return for you, but there's no guarantee. Where if you're paying off debt that, is at a certain interest rate, that's a guaranteed return on your money.
Yeah, absolutely. But back to the folks that I have been talking to that have come to me with, pretty heavily invested portfolios. A common thread that I'm seeing here is probably more recently than I can recall in recent times. These folks are starting to really say, this just doesn't make sense to me. I see what's going on in the real economy. I see what's happening with, social distancing and even excesses that maybe had caught up, were too large even without the coronavirus starting to come home to roost. And yet I'm hearing my own inner voice or my financial advisor that I've worked with, for, a dozen years or whatever, giving me more of the same of, hey, don't worry about it. This market's going to go higher. It's, even if it goes down, it'll bounce back. And, look at the market's already priced in the impact of coronavirus, and people are shaking their heads and saying, no way. My gut is telling me even that just doesn't make sense. So I'm hearing a really, kind of profound struggle that people maybe have ridden this up and have been, hearing the party line suddenly saying, no way, I don't believe it. And when I share with them, I show them objective data, because we're doing a lot of screen sharing these days, not just phone calls, but with Zoom, we're able to pull up charts of not anybody's opinion, not our belief, but raw data that we can go back and look at. And when they see that stocks are valued at literally the, highest times in all of history, right up there with, right before the Great Depression, right before the tech bubble, and they see that and they hear the mantra of, markets are just fine, don't, trust the markets. It gives them that extra, bit of evidence to say, I'm trusting my gut this time. And I want someone to help me get out of the market in a thoughtful way, but also, to your last point, be prepared to act decisively and convincingly based upon data, based upon, not emotion, but real actionable data points to get back in degrees, and then, entirely, as the case might be, based upon where markets are. So I'm not only hearing that from folks calling me about their own situation, but I'm hearing more and more folks, and including existing clients of ours, starting to reach out and have their family members, the friends, kind of reach out to us because they care about them. And so I've had a lot of conversations with children and their parents, siblings and their brothers or sisters, friends referring folks to us, because it feels bigger than themselves at this point. They want to help the people that they care about.
Great. Thanks, John. Again, we're so thankful for the work that you guys do at New Harbour, helping people think through all of that, because we get contacted all the time by people who are wrestling with what to do and have such a hard time finding a financial advisor that thinks like them. If they call their general, regular broker, they're just being told, don't worry, the stock market will take care of you in the long run. And as you were saying, that they're finding that is increasingly conflicting with what their gut is telling them. So to be able to talk to somebody who says, oh, actually, we think you should listen to your gut, and here's the data that shows why, that's very cathartic for people, but it also helps put them in an action mode where it actually enables them to just stop twisting in uncertainty and anxiety and actually begin to start taking real action. So a huge thank you to you and Mike and the team at New Harbour. I want to underscore something you said earlier too, the difference between bull markets and bear markets. Bull markets are processes, where bear markets, or let me put it this way, market tops are processes, corrections are events. So you sort of talked about, there's a reason they call it the bear market. It's like a bear coming and just slashing everything at once, right? The corrections tend to be fast and furious. And because of that nature, they tend to happen before people can react. So most people, I think, the average investor sort of in the back of their mind says, yeah, when it begins to look a little squirrely, I'll eventually get out before it gets bad. And of course, what happens is the market corrects in a matter of days usually, and they're just caught flat-footed, right? So again, being able to talk with somebody like you and coming up with an advanced plan so that they're not caught unawares, hugely, hugely valuable. All right. So with that, guys, looking at the time, we have, as usual, gone longer than I initially intended, but it's always so great talking with you guys, and you guys have such great content and perspective to share with folks. So thank you again for doing that. And I know you're doing that since I know the number of people we're sending your way with questions. I know you guys are super busy with client calls and client meetings, and your trades you got to place and all that kind of stuff. So I appreciate you taking this much time out of your busy day to help educate folks. As always, we will put up the link so that if somebody wants to chat with you guys, they can. And if you're a new viewer, the relationship that we've worked out between Peak Prosperity and New Harbour is that you can reach out to them and have a completely free, completely no strings attached, no commitments, nothing, conversation with them about your personal financial situation, and they'll give you their perspective on how well you're positioned and what they think you might want to do with your portfolio. And that's it. If you like what they have to say and want to talk with them further, great, you can do that. But again, there's no expectation to do that. So if that's of interest to you, just go to the URL that's here on the screen, greylockpeak.com. And there's a quick form that you fill out there. It probably takes you 10 seconds. And then somebody from New Harbour will reach back out to you. One quick thing that I keep forgetting to say every week, New Harbour, they're US based, so they're really only able to help US clients. If you're international, they cannot manage funds for you. So just want to give you that warning up front, because sometimes we're getting a lot of volume from non-US folks, and we don't want to set people up for disappointment.
Adam, just a little clarification on that.
Sure.
So U.S. residents residing overseas, we can work with. Green card holders, even if they're overseas, we can work with. It's just true foreign residents and citizens, due to a whole host of regulations, we can't really work with, unfortunately.
All right, good clarification, right? So if you're a U.S. national or green card holder and you're living outside the U.S., you can still work with them. And real quickly, we have a business relationship with the guys at New Harbour. We have to have that business relationship in place to be able to send people like you over to them in an SEC compliant way. All of the details of that relationship are provided on that Greylock Peak URL website I mentioned where the form is. And the key thing to know about that is in no way, shape, or form, if you end up deciding to work with New Harbour, impacts the quality of service you get or the cost of the service. It costs exactly the same as if you had walked through the front door of their offices. In fact, you're probably going to get more attention from them coming from Peak Prosperity, so it's only goodness. But we do like to be fully transparent and make sure that everybody is aware of what's going on. All right, so with that, guys, I want to thank you again for doing what you're doing, helping all those people. I call it a public service, and I continue to do that because you guys are just helping so many people, especially now at a time where there's so much uncertainty out there. And one thing you did mention, John, I do want to talk about for just a quick second here in closing. You said that people are coming to you and asking for your help in talking to their family members or close friends about the risks of the current market and maybe, helping them understand the situation and helping them maybe decide to take some prudent action. If you're watching and you have people like that in your life, now is a really good time to do that, because I think you're going to find a lot more openness than you would have 4 months ago, right? After 10 years of the stock market basically marching higher to record high every month for a decade, most people had become extremely complacent about the markets. Whether they're big investors themselves or they just have their money in a company retirement account, I think people were not very worried. And a lot of the types of concerns that we talked about today were not on people's radar screens. Well, the market downdraft that the coronavirus created, it woke a lot of people up. And before they fully put their heads back in the sand and lull themselves back to sleep, I think you really do have a window of opportunity here to engage those people in a much more reality-based discussion around how to manage their wealth, their financial wealth. So anyways, wanted to underscore that. Guys, thanks so much. Look forward to doing this next week. And thanks again for taking the time, and can't wait to see what the next week brings.
Thank you, Adam. Appreciate it.
Thanks, Adam. We really appreciate you putting these videos together. Thanks.
See you soon, guys.
See you later. Bye.
Bye now.